So, hi everybody, this is Hustle Hub and Giacomo, and today I'm with Jordan Lambert from Convequity, and today he made a presentation on cybersecurity, the cybersecurity sector as a whole, and the investment landscape of the cybersecurity sector. So, he's going to explain the big trends in cybersecurity. So, without further ado, Jordan, introduce yourself and let's get into the presentation.
Right, thank you, Jacobo. Thanks for having me on. I think it's the third or fourth time we've presented for you. Usually it's myself and
fourth, I think. Fourth.
It's the fourth, right? Usually it's myself and my partner, my research partner Simon, but he's unavailable today. So we have both contributed to this presentation, but it will just be me presenting it to your viewers. Cybersecurity is quite an interesting subsector within technology because it's quite resilient. It's proven to be very resilient over the last few years, especially over the pandemic era. And this is kind of when organizations have been cutting their IT budgets, cybersecurity appears to be one of the last items that is to be cut, if cut at all. There's many companies that have actually increased their spending on cybersecurity. And this is because cybersecurity has some very unique dynamics compared to other sectors in technology. It has an adversarial nature to it. You have companies that are changing their digital landscape as they aim to evolve. They're adding more cloud computing, edge compute, IoT, managing this hybrid model for the distributed enterprise. And this is just creating more and more vulnerabilities in tandem as they expand their digital surface. And this is creating ample opportunities for cyber criminals to look to exploit, look to see if there's new threats that they can use and new attack vectors. So because of this adversarial dynamic, organizations are always needing new solutions to combat these new threats. Oftentimes these new solutions can come from startups. Maybe these startups have emerged specifically to protect against that particular threat, or sometimes solutions can come from incumbent vendors that have expanded their platform in order to better protect these enterprises to these new threats. So you've got that constant adversarial nature, that dynamism, which just makes the cybersecurity sector very, very in demand. Even in this situation where the macro climate has been deteriorating, cybersecurity spend is remaining quite elevated. And so what we plan to do in this presentation, and well, the purpose of the presentation is to articulate that cybersecurity is extremely fragmented, and it has been for a long time, but we feel like it has reached peak fragmentation. And from here going forward, there's going to be, on a net basis, more consolidation than there is a continuation of fragmentation. And we think that's going to be very beneficial for the likes of Palo Alto Networks, which is a leader in cybersecurity. It's a public stock, and names like Fortinet, SentinelOne, Cloudflare, and even Crowdstrike and Zscaler as well. So this, we're predicting consolidation is going to basically benefit these companies. So that's what this presentation is about. A quick disclaimer for your viewers, Giacomo, if they can just pause and give that a quick read. So, yeah, as just briefly pointed out, we want to explain how fragmented the cybersecurity landscape is. But first, it's worthwhile taking a step back and considering how fragmented the broader SaaS economy is, but also take a step even further back to understand why it's become this fragmented. So in the pre-cloud era, you had companies managing their own software in their own on-prem data centers. And much of this would comprise of managing a giant ERP system, which stands for Enterprise Resource Planning. And this system might be provided by Oracle or SAP or IBM or any of those kind of legacy names. And within this ERP system, you'd have subsystems like a CRM, any type of HR system. And it'd be quite unwieldy to use, difficult to manage, and not very scalable. For instance, if you wanted to add additional functionality to this ERP system, companies would have to take several months to implement that. So not easy to manage, not easy to scale. So then when Amazon launched AWS in 2006, the beginning of the cloud computing era, this very much swiveled that on its head. We had many tech entrepreneurs thinking, right, okay, I'm going to pick out a single solution out of this vast ERP system, and I'm going to deliver it from the cloud, from AWS. No installation is required. It's just users are going to receive the software in their browser. And many tech entrepreneurs followed suit, and hundreds, if not thousands of tech entrepreneurs did this. And many of these entrepreneurs were actually engineers formerly at either Oracle or SAP, because they had first-hand experience of what the customer frustrations were like. So it gave them an advantage. So we had, thousands of tech entrepreneurs picking out an individual solution within these vast ERP systems and just delivering it from the cloud, software as a service, improving the end user experience and also the experience for IT administration as well. And it was just a benefit for companies, because if they needed to quickly add new functionality or a different solution, it wouldn't take them several months to implement. They could just, go to AWS, have a shop around, say, all right, I'll have that, and it's deployed within a few minutes. So you can see why SaaS applications are proliferated. And this slide here, it just depicts the marketing technology landscape within SaaS. It's, and that's just one subsector of the overall SaaS economy. So, multiply this fragmentation that you're seeing here by a number of times to get the full picture of SaaS. And the benefits of this, of SaaS and the kind of proliferation outweighed the inefficiencies of the fragmentation for much of the 2010s. Because there were some blind spots when you're managing all these apps, but these SaaS apps are quite rich in APIs, so they can talk to one another. So to a degree, you do have some visibility, but I guess the operative term is to a degree, because nowadays enterprises are managing maybe 400 different apps or even more. And even with rich API connectivity, inevitably you're going to have operational slowdowns. You're going to have many blind spots. You've got many data silos, because a company's data is being held in third-party applications. And you've got lots of shadow IT as well. Shadow IT is where business users will download and begin using a SaaS app for corporate use without IT's approval. So therefore, IT have blind spots, they're not fully aware of the inventory of SaaS apps that are in use within their corporation. And all this kind of funnels down into grave security concerns. Again, it comes down to the visibility and the time spent in trying to get all these different solutions correlate with one another. And cybersecurity is one of the more fragmented sectors within the overall SaaS economy. And this is because of the adversarial nature that I pointed out earlier. And also it's worth pointing out that cybercrime, the risk-adjusted returns on cybercrime is just unparalleled. It's not compared to anything else. No, not even comparable to, say, cocaine trafficking in the 1990s. You know, for doing some for a sophisticated cyber criminal, they wanted to attack an organization with some ransomware. The risks of getting caught are almost negligible. Very, very small risks, but the payouts are potentially huge. So with that in mind, it's no surprise that these cyber criminals are constantly looking for new ways into the enterprises, which has become easier as companies are expanding their digital attack surface. So yeah, you've got the cybersecurity industry basically playing catch up all the time. Companies are making themselves more vulnerable as they digitalize, digitally transform. Cyber criminals are on the lookout for opportunities, and then cybersecurity is always playing catch up. And the reason it's so fragmented is because often when a new threat emerges, often the best solution comes from a startup, because that startup has come into existence in order to protect against that very threat, that specific threat. So we put all their resources into protecting against that threat, and they make a very, very good solution. And very often you'll find chief investment security officers, when they hear about a new threat, they often just want the best of breed. You know, they'll tell their security analysts, get me the best solution to defend against this new threat. And that's what causes this type of fragmentation. So today, the typical enterprise might have, you know, be managing 50 different vendors and maybe even more individual security point solutions. So this is the kind of fragmentation side that we're trying to paint, and why we believe on the market demand side, fragmentation is almost at a peak level, because going forward, is more fragmentation going to benefit organizations? Because ironically, if you keep adding more, security vendors and more security solutions, you're actually weakening your overarching security posture. So that's a bit of a oxymoron there. Like, you're adding more security, but you're actually weakening the security posture. So this slide is purposely blank. I was looking for a graphic to illustrate consolidation, but it slipped my mind. So here it is. It's a blank slide, but we can discuss at least what is going to drive the next wave of value. As I said, more fragmentation from here going forward isn't really going to drive any more value for organizations. Yes, they might get another best of breed solution to protect against a particular threat, but if they keep doing that, really their security posture is weakening and giving cyber criminals actually more opportunity. So we think it's peak fragmentation in cybersecurity, and kind of going forward, things are going to consolidate to a degree. It's never going to be a consolidated market compared to other markets in the economy, because you need a lot of fragmentation and innovation in order to keep the industry vibrant. It can't afford to be stale, because that's when cyber criminals will finally win for good. But talking about consolidation, there's kind of numerous examples where tranches of an economy or sector of an economy has consolidated and generated value, or vice versa, has fragmented and generated value. It just happens over time. I won't go into details, but if viewers are interested, check out what IBM did with the mainframe in 1950, or what Intel did with the digital circuitry inside a computer in the 1970s. They basically combined all the key components of the digital circuitry into one microprocessor in the 1970s and revolutionized chips. And then you have Microsoft in the 1980s. They consolidated and centralized the operating system. Actually, before Microsoft did that, every computer, every PC had its own operating system, bespoke operating system pretty much. So what Microsoft came in and consolidated that section of the technology stack. And more recently, you have what Amazon have done with cloud computing. They've consolidated their cloud computing resources, centralized it to create massive amounts of value. Apple, probably you could say they've done a similar thing with mobile apps as well. And it's not just technology as well that we see this happen. An example, a non-technology example is like Skyscanner or something like that. Now, before Skyscanner, it would be quite an arduous job to be checking and comparing flights, but Skyscanner has kind of come in at a layer and provided centralization and kind of consolidated the market and made it, provided a better user experience. So this happens all the time. So it's like, but it only happens when things get so fragmented that the only way forward to drive that next wave of value is consolidation. So we've spoke about the market demand factors that we think, and we're not alone in thinking this, by the way, we think is going to drive consolidation, but there's also funding supply side factors as well. So in this triangle, we have venture capitalists and startups. So we tied to each one of these corners of this triangle, where we're making a prediction in the following slide. So with venture capitalists and startups, we're saying that basically there's going to be fewer funds flow through to early stage startups. And that is going to have a consolidating impact on the cybersecurity industry. With the private equity firms and second tier players, we're seeing a lot of activity where PEs are acquiring second tier players. And we think that is a consolidating impact on the industry, but we think it's going to create an innovation divide, or a greater innovation divide between second tier players and first tier players like Palo Alto Networks and Cloudflare and Fortinet, etc. And the outcome of those two, the VCs and the PEs, we think is going to lead to a more favorable market for first tier players and best of breed startups. So that's what it's the kind of the premise of the presentation is this. So I'll proceed on to the next slide. If you have any questions, Giacomo, just don't hesitate.
No, I don't have questions at the moment, but I can see the trend, like risk aversion. Therefore, there's less capital at the start, basically seed capital, and probably people moving down the risk ladder, right?
Yeah, absolutely. Yeah. So it's just becoming quite. The VCs are just slowing their investment pace and being more selective in their investments and de-risking.
Yeah, that's also because of the trend in interest rates as a whole. So
yeah,
people
absolutely
are okay with less risk, and yeah, probably there's less capital out there as a result of the increase in interest rates, right?
Absolutely, yes. And as we'll touch on in the following slides, it's they're slowing down their investment pace because of the impact that these drawdowns throughout the financial markets is the impact it's having on limited partners who are investors in their funds. So we'll touch on that in a few slides. So the first prediction is the startup landscape will consolidate at the early to mid stages for a number of startups. One of the first reasons is because the per startup funding demand has dropped quite radically. So in the third quarter of 2022, on a per startup basis, funding dropped 54%. So in the third quarter of 2022, the average funding was 16 million for a startup. That's got a real big drop. And the big reason for this is that, well, in regards to cybersecurity, and yeah, this is just based on cybersecurity firms, by the way, just point that out. It's a really good report published by Momentum Cyber that I recommend viewers to go and check out. And bear in mind that since kind of 2017, 2018, there's been a sharp increase in cybersecurity startups. And then that accelerated somewhat more during the pandemic, as there was a rush to the cloud and there's a lot of tech entrepreneurs seeing opportunities there. So you had a rise in the number of startups, and that was met with commensurate increases in funding during kind of 2020, 2021, and a little bit of 2022. But now, because of the economic climate, VCs have tempered down their investment pace. So it's resulted in quite a sheer drop in the amount of funding available for each startup. And 16 million, you know, is quite a drop, and that's an average. So there'll be many startups that are only getting a few million, and it just won't be enough for them to survive. So we'll move on to the following slide. So we found some really interesting research and a survey from January Ventures. They carried out a survey from August through to October 2022, where they interviewed 450 founders, startup founders of early stage companies. And 43% of those founders said that investors were slowing down their investment pace. And 38% of those founders said that it appears that investors are backing people they know, you know, they're leveraging social ties rather than investing in people who don't have any social ties with. And also there's been an increase in investors negotiating on price, which is a big contrast to kind of 12 months ago when VCs were scrambling to be the lead investors for almost any startup that had a bit of growth. And, you know, price wasn't really a major consideration because they thought every startup was going to be a unicorn or a decacorn. And also, there's a 10% of investors putting structure into deals, which was less likely 12 months ago. So it's interesting because, so investors are certainly, VC investors are certainly slowing down their pace. And as the next slide shows, again, from the same January Ventures survey, it shows that these founders say that within 12 months, they're going to be running out of cash. So 81% of these founders said within 12 months are going to be running out of cash. And bear in mind, this was in kind of August to October 2022. So fast forward to today, it's possible that in the next 6 months, many of these 450 early stage founders are going to run out of cash and we're going to need to make a beeline to the markets to raise funds. But because of the drop in risk appetite from venture capitalists, many are not going to get the cash that they need, and many will fold. I think it's inevitable that many will fold. And again, so this is a consolidating impact on the cybersecurity market that is kind of being driven from the funding side rather than the market dynamic side that we mentioned earlier. Firstly, I apologize for the poor graphics ability here. Just could not get that blue line to be really smooth for some reason. But anyway, it picks basically that investors, wherever they are, whatever they do, are kind of shifting back along the risk curve, kind of de-risking to a degree. So when early stage startups do need to raise funds in the next 6 to 18 months, many will not receive the required funds because VCs will most likely be retreating back along that risk curve. And this will lead to fewer funds for early stage and more funds for late stage. So there are some venture capitalists that kind of invest right across the spectrum. So they will, they put money in seed, Series A, Series B, Series C, etc., up to Series F and G. But most VCs do focus on a particular tranche within that spectrum. So, for example, a venture capitalist that is focused on Series B and Series C, equally, right now, if they are willing to invest, they'll be more inclined to invest in the Series C startups, because within their kind of investment universe, those are slightly less risky. They have slightly more of a confirmed product market fit, slightly more of a go-to-market strategy that's looking successful, etc. So everyone does this, all VCs do this. You basically mid-stage startups will probably get more than the early stage, and then late stage startups will probably get more than the mid-stage. And again, unfortunately for the early stage and some mid-stage, we're going to run out of funds and most likely fold. This is an interesting chart we found from JP Morgan. It just shows you that the asset returns and the dispersion in asset returns over the previous 10 years. We were surprised when we saw this. It shows you that venture capital is quite a wide dispersion, as you would expect. But normally one would probably think that the risk-adjusted returns for venture capital is higher, but you can see that the median here is on par or even a little bit lower than global private equity. So you don't really need to apply a Sharpe ratio or anything like that to know that the risk-adjusted returns for global venture capital over the last 10 years on average hasn't been highly attractive. And again, this is largely because of the cloud computing phenomenon. It's catalyzed thousands of startups, and venture capital has chased these startups, and now there are thousands of VCs as well, and it's just saturated the software industry. And it's like we're in any investment sector, not everybody can be big winners. So don't get me wrong, there are a few venture capitalists, the elite ones, that have fantastic returns, fantastic risk-adjusted returns, but unfortunately for the majority of VCs, the risk-adjusted returns are okay. They're doing okay, but when you compare the risk-reward to other asset classes, it's not highly impressive. So we think that the knowledge of these mediocre risk-adjusted returns may temper the venture capital funded landscape in years to come. So yeah, we may just get many people deciding not to go into venture capital or turn to something else. So here's a summary. So in the earlier part of the presentation, we spoke about the market demand factors. The peak fragmentation is, we believe we are at peak fragmentation going forward on a net basis. It's going to be more of a consolidation. But also the funding supply factors support that as well. Just fewer funds are going to flow through to the early stage startups. And consolidate the cybersecurity industry. And this is very, very important for the likes of Palo Alto Networks and other public cybersecurity leaders, because, well, with Palo Alto in particular, they are heavily in cloud security, and they have a leading cloud security platform called Prisma Cloud, but they have a lot of competition from startups, many early stage startups. So going forward, if these run out of cash and they have to fold, then it's just good news for Palo Alto Networks. We'll move on to the second section of that triangle. So private equity firms have had a major interest in the cybersecurity industry of late. Here is just some notable M&A deals where private equity firms have acquired cybersecurity companies. That's in the top half of the table, and then in the bottom half of the table, we just show the market caps and multiples of some public cybersecurity names, just for comparison purposes. So obviously, this is going to consolidate the cybersecurity industry. But what we think the bigger impact we think it will have is private equity firms are generally focused on improving operational efficiencies, improving profitability, operating leverage, and less focused on making ambitious bets in R&D in order to come up with the next cutting-edge piece of software. So as these second tiers are acquired by PEs and they become more profitable, and there's a huge scope for them to become more profitable because many of them on a GAAP basis were making losses at the operating level. They'll become more profitable, but that divide, if whatever the divide was between these second tier players and first tier names, will probably widen over time as they are now owned by private equity firms. So we think this is good news for the likes of Palo Alto, Fortinet, Cloudflare, CrowdStrike. Right, so this is what's happened in the past. But will that continuation of software-focused private equity firms consolidate the cybersecurity market? Will it continue? Well, in the last year, in 2022, we have seen a decline in sentiment for private equity. So the chart on the left shows you that the liquidity in the private equity market has declined, probably that is expected. And also the amount of fundraising in 2022 was also off its highs compared to 2021. So sentiment has dipped. However, the dry powder pool of capital available for private equity firms is still near historical highs. So in 2022, we can see that over 1.2 trillion of capital is available for private equity firms, but this is committed capital from limited partners. It's not actually cash in their hands, so to speak, but it is the amount of capital that is being committed. And 63% of this 1.2 trillion has been raised since 2019, 2020, and in 2021. That's 63%. So that's quite a big chunk in the last few years. And if we say kind of, I don't know, that the average vintage year is based on what we've just described is kind of 2020, then the limited partners, if they have a typical investment horizon of 10 years, then that should take them to say 2030 is when they want their money back, right? So if you kind of work backwards from there, and private equity firms typically hold portfolio companies for 5 to 7 years, and you kind of work backwards to work out that, right, okay, 2023 should be a year where a significant portion of this 1.2 trillion should be deployed, and immediately thereafter as well. And because cybersecurity is one of the ripest subsectors for consolidation, we expect to see a continuation of this private equity activity. So this is just the summary of this section. So we know that software-focused private equity firms are seeing huge opportunities in cybersecurity. However, private equity firms tend to be more focused on operational excellence than they are in innovation. So this should widen the divide between the second-tier names that they are acquiring and first-tier names like Palo Alto Networks, Fortinet, CrowdStrike, etc. There has been a drop in risk appetite over the last 12 months, but the dry powder pool is still near historical highs. And given the general private equity timeframes for limited partners and private equity firms themselves, it feels like a good portion of this capital should be invested in 2023 or immediately thereafter. So the last bullet point, just more consolidation should lead to a wider innovation divide, which is good news for Palo Alto and these other names. So what's happening in the VC and startup world and what's happening in private equity and these second tier names is kind of helping these public market leaders and the best of breed landscape. So the third prediction is market leading public cybersecurity names will experience a more favorable M&A landscape and also lower competition as well, we might add. So fewer early and mid-stage startups will mean less future competition for Palo Alto and other public names. It will also mean that the best of breed of this space within the startup world will stand out more. So I think this is quite important for Palo Alto's due diligence. So they'll be able to scan the market more efficiently, identify who the true best of breed startups are. And it will also, if the VCs are being fearful or moderating their investment pace at the moment, if public players can perhaps be more greedy, they might have an opportunity to land some real good bargains of these best of breed startups. So to summarize, the VC startup and PE legacy investment landscape should be beneficial for the market leaders' future competitive environment and also for these market leaders' M&A environment. So what the opinions and views we've shared so far are not completely our own. They have been shaped by what we've seen and heard other people talk about. But for some balance, here are some opposing viewpoints, but in the red text we do counter those. So by some estimates, the dry powder pool for venture capital is 300 billion. Remember earlier, the dry powder pool was 1.2 trillion, but that was for private equity. But the estimates for venture capital alone is about 3 billion. So perhaps that amount of capital means that all startups are going to get funded the required amount. But this 300 billion is not the amount of cash actually sitting at these venture capital firms. It's only a commitment by the limited partners. So given that the limited partners investment portfolio has been drawn down significantly, whether they're invested in public names, venture capital, private equity, real estate, they've experienced sharp drawdowns and they experience tight liquidity. So if the venture capital firms actually called this 300 billion right now, it's very unlikely that the LPs will be able to honor this commitment. And they know this, the VCs know this. So that's one reason why they will be moderating their pace of investments. So again, another reason why we think fewer funds will flow to the early stage. Another opposing viewpoint is that there might be some kind of bifurcation between the broader SaaS industry and cybersecurity itself. And perhaps the SaaS industry may consolidate, but as cybersecurity has these unique dynamics, perhaps the startups that provide protections to these new threats will continue prevailing. And this could happen. I mean, we could be wrong. Fragmentation may continue, and there might even be more startups this time next year. And this best of breed versus consolidation debate in CISO circles has been going on for a long time. But as I say, we feel like it's at a tipping point. And really, if a chief investment security officer decides to go with Palo Alto Networks, they're kind of having their cake and eating it, so to speak, because Palo Alto has a very broad platform that can provide protection against a broad range of threats. But within that platform, they also have best of breed solutions, some of which has been acquired. They've acquired a startup and integrated it into their platform, or some solutions that have been built from the ground up by themselves. So yeah, with Palo Alto and a couple of other names, you really can have the best of both worlds. So now we're just going on to the public market leaders overview. The slide we showed earlier about how fragmented the cybersecurity industry is, is quite daunting. But really, at a high level, you can break down cybersecurity into 4 areas generally. Well, there's lots of ways to slice and dice it, but this is how we've breaking it down. So you have network security, which is bread and butter of most cybersecurity activity. It involves having a firewall essentially at the perimeter of the corporate network, and that acts as a gateway, allowing or disallowing connections inbound to the corporate network. But there's been a lot of innovation in that space since enterprises have become more distributed in the last couple of years. Cloud security is another big area because of enterprises rush to the cloud. And they've been digitalizing, but often security is an afterthought. So cloud security is always playing catch up, and it's a huge area of cybersecurity right now. And then security operations kind of ties all that together. It's about receiving telemetry and doing operations in the cloud to hunt for threats, detect, respond to threats, and remediate environments to state of hygiene. And then kind of wrapping around all that, kind of infused into all those 3 areas is identity, which is all about kind of providing a seamless login experience for users, single sign-on experience, where employees can sign in once and securely access multiple apps. It also entails managing the credentials and access requirements of an employee as they kind of work their way through an organization over time. This is the same chart but just populated with some key names, key leaders within each of those areas. It's not an exhaustive list, it's just off the top of our minds some leaders. And then I think this would be quite a good foundational diagram for viewers to take if they were interested in doing some of their own research into cybersecurity. It's a good starting point. So Palo Alto Networks and Fortinet. Just be brief with the next few slides. So Palo Alto Networks and Fortinet, they originated in network security. They're both firewall vendors originally, fierce rivals during the 2000s and the 2010s, and also today. But Palo Alto Networks has successfully expanded from network security into security operations, cloud security, but probably it is regarded as one of the leaders in cloud security at the moment. They've made a very successful transition into cloud security and have a leading platform called Prisma Cloud. Fortinet has also expanded from network security, but not being as successful in security operations and cloud security, but it is capitalizing on the trend of networking and security converging together, which has been very attractive, expedited by the pandemic and remote work from home, work from anywhere kind of models in a distributed enterprise. So yeah, both these companies have many tailwinds that they are capitalizing on, as we'll discuss in a bit more later. Cloudflare, they actually started off as a content delivery network provider, which basically accelerates the speed at which users receive website content. And they quickly built a dense global network of data centers, which they use to improve the performance of websites and also protect them from attacks. And in recent years, they've begun leveraging this vast and dense network and infrastructure to provide network security for enterprises. And their main unique selling point versus Palo Alto and Fortinet is that they are a purely cloud delivered vendor. So there's no hardware boxes required to be installed on premises. Zscaler is a close competitor to Cloudflare in network security, and also Palo Alto and Fortinet. They started off in something called Secure Web Gateway, which is basically protecting employees and their devices as they connect to the internet. And since then, they've expanded into adjacent areas, and they are today one of the clear leaders in off-prem cloud-delivered network security. So, like Cloudflare and solutions that the others can do as well. Companies will route their network, their traffic through to Zscaler in a data center. And Zscaler will inspect that traffic and either block it or send it on to its destination. CrowdStrike and SentinelOne, these guys are fierce rivals in endpoint security. So, which forms a big part of security operations, by the way. So it might be worthwhile just explaining a bit about endpoint security. So with endpoint security, you could describe it as having two components. You have one component, which is the agent, like you have a software agent installed on the endpoint, and that can be a laptop, a PC, a workstation, yeah? And sometimes that agent can stop threats itself, you know, it's basically an antivirus agent, you know, but not as kind of legacy as the old antivirus software that many people would have on their computers. And they'd be able to block and stop threats, but mainly they send telemetry to the other component of endpoint security, which is in the cloud. So you have a bunch of security analysts in the cloud, but ingesting all this telemetry, doing analysis, hunting for threats, detecting, responding to threats, and remediating environments to a safe environment. So CrowdStrike, their focus on endpoint security, which again forms a big part of security operations, is they have a very, very lightweight agent, but a big focus on the cloud side. Yep, so that their agent just pretty much sends telemetry to the cloud for their analysts to then do their magic. SentinelOne has taken a different approach and had more of an equal emphasis on the agent and the cloud operations. So their agent doesn't just send telemetry to the cloud; it actually can catch and stop a lot of the threats that are coming onto endpoints. So they've both got a different way of approaching endpoint security and security operations on a larger scale, and they are fierce rivals. You should check out their marketing games that they play with one another. But a big portion of their marketing is just about discrediting the other rival. But we'd say architecturally, SentinelOne is probably a better comparison with Palo Alto Networks and their security operations and endpoint security, because both are a very modern stack for security operations. So we just move on to some valuation considerations quickly here. This chart is on the y-axis, you have enterprise value to gross profit. On the x-axis, you had the latest growth in revenue based on the latest quarter. We like using enterprise value to gross profit because it's a nice in-betweener, in between kind of EV to sales and EV to EBITDA. Because EV to EBITDA or EV to EBIT can often be noisy. And often for many of these high growth technology stocks, it's not even applicable because they have negative operating margins. And also using EV to sales is also useful, but it doesn't really give you any information about the margins, right? So that's why I think enterprise value to gross profit is good in between, because at least it factors in the gross margin element. And to us, especially for these type of companies, gross margin is an important consideration, because if a software company does have 70 to 80% gross margins, okay, they may be losing at the operating level in the time being, but you know, with 80% gross margin, you would expect that they have a lot of room for operating leverage. So you would expect these companies, when they hit that mature stage, to be quite profitable. So that's why we kind of like this metric. Anyway, we can see that Palo Alto Networks and Fortinet, if you was to draw a line of best fit across this chart, you would probably say that Palo Alto and Fortinet would probably be relatively fair valued. Well, so fair valued on a relative sense, not an absolute sense. But as we, based on our fundamental research and our qualitative research, we just think that they have very durable growth at an already high revenue base. You've got to bear in mind that these two companies, Palo Alto Networks is approaching 6 billion in revenue. Fortinet has surpassed 4 billion. And in the latest quarters, they've been growing at 30+%. So growing at like 30% or more when you're at 4 billion or 6 billion in revenue, you are gaining significant market share. And even going forward, the outlook is quite positive, 20+% going forward. So we just think the durable growth or durable market share gains is not really being fully appreciated by the market. You know, whereas many analysts will be kind of take whatever company they're focusing on, many analysts will linearly decelerate the growth projection. And that's, you know, that's natural. You do expect growth to decelerate as a company gets larger. However, yeah, we just think that deceleration for Palo Alto and Fortinet is going to be less, you know, because of the so many tailwinds, and mainly, you know, because of this consolidation theme that we've been articulating here. Cloudflare is not cheap. Actually, they aren't even on this chart. They are quite a bit higher, especially after the recent share price rise. You know, their EV to gross profit is probably close to 30 times. But so not cheap, but currently a hold in our opinion. We do, you know, probably should share some disclosures. We are investors in Palo Alto, Fortinet, Cloudflare, and SentinelOne. They're not cheap, but we aren't going to sell Cloudflare. Just we consider it a long-term holding. What we think most investors at large aren't fully appreciating is that Cloudflare could be an eventual alternative to the hyperscalers, and it looks like the only one around that could be a potential alternative, because the four pillars of cloud computing are security, networking, and compute and storage. And Cloudflare does all of those, just like a hyperscaler like AWS or Azure does. And probably storage is their weakest area at the moment, but they are fast improving. So they could, and especially with their networking prowess, they could actually be one of the first, what we call super clouds, where, yeah, a super cloud kind of sits above the other public clouds. And just makes deployment, operations more simple, just increases the time to market and reduces costs for all these enterprises that are using multi-cloud environments. So we think we have a real good long-term opportunity. Zscaler also very impressive product momentum and growth. But I don't think the growth guidance in the latest quarter is as impressive as Palo Alto or Fortinet, considering these guys have a much higher revenue base. But nonetheless, it's very well-run business. And lastly, SentinelOne, Crowdstrike. You can see, again, if you're going to envisage a line of best fit on this chart, you can see that SentinelOne is quite undervalued compared to its growth rate. And that is because its operating margins are deeply negative. Interestingly, that's CrowdStrike and SentinelOne both were founded about only 14 months apart. CrowdStrike was founded in 2011. SentinelOne was founded in 2013. CrowdStrike had a much faster go-to-market strategy. So they hit the market with ground running, and they quickly grew a large market share. And SentinelOne was kind of more focused on the product market fit rather than the go-to market, and it took them a longer time to perfect the product and then decide, right, okay, we're going to go to the market now. And so SentinelOne's kind of playing catch up to CrowdStrike. CrowdStrike's revenue is about 2 billion, SentinelOne is, a few hundred. So the reason, in order to catch them up, they have to spend big on sales and marketing, and that's what SentinelOne is doing. They believe they have a better product architecturally, and that's why they're spending big. So in the near term, huge operating losses for SentinelOne, but it's translating into very high growth. But the important thing with SentinelOne is the rate of change in their margins, which quarter to quarter it is improving. Same with Palo Alto Networks as well. They on a GAAP basis they've only just broke even at the operating level, but the rate of change is what investors are going to be drawn to in the next quarters. So that's something for your viewers to think about if they're interested in any of these stocks. Right, so in the description of this video, Giacomo, we'll leave some DCF valuation models, a Google Sheets link. We have ones on the ones we're invested in: Palo Alto, Fortinet, SentinelOne, and Cloudflare. So we'll do that. Generally, we just think there's a 2x upside in the share price of Palo Alto, Fortinet, SentinelOne. We recently conducted our valuations of these companies. We don't think that reaching that fair value or that intrinsic value deserves to be done immediately, because that would perhaps push the multiples a bit too high, especially given the current climate. But we think over the next year or two, they should be on the trajectory to reach these valuations. But we'll let the viewers, if they're interested, take a look at the links. So instead of a bullet point conclusion slide, just put it into a diagram. So the consolidation impact. So consolidation in cybersecurity is coming from the market demand factors, peak fragmentation going forward. How can the next wave of value be created? It can't be more fragmentation, surely, or can it? We don't think it will be. We think it needs to be going forward a bit more consolidation. That's not to say the market will consolidate entirely, because cybersecurity needs a lot of fragmentation, a lot of players doing their thing, but we do think there will be a degree of consolidation. And also, it seems as though fewer funds are going to be flowing down to early stage startups and maybe some mid stage startups. And also these legacy names are consolidating as well, which should ruin their innovation even more, in our opinion. So we think this will lead to fewer competitors for Palo Alto and other names at the startup level, and also create a divide between them and the second tier names. And also it should present a better M&A landscape as well. And we think you can use this diagram going from left to right, so consolidation to less competition, and then that feeds into more attractive valuations. So again, if the market is going to consolidate, well, we know for a fact that investors at large will not be kind of factoring this into any growth projections. As I say, the main way to view or forecast growth is to do sharp decelerations, especially when companies have reached a few billion in revenue. We think revenue growth will decelerate, but less steep, so because of these tailwinds, because of these consolidating factors. And interestingly, many of these stocks have experienced a sharp drop in their stock price, but their growth hasn't dropped to the same degree. So that's another valuation consideration to take into account. So yeah, that's it, Giacomo. Do you have any questions?
Yeah, sure. So one thing that I would like to ask is, so this trend in VC, is it something that is mainly caused by the interest rate situation, the monetary policy, or is it here to stay? So the vision fund era is over. So easy money in venture capital is over, regardless of interest rates.
Yeah, well, I think interest rates will hurt VCs, no doubt. It hurts everybody as they rise. But you know, they are probably their financing of their funds is less with loans and it's more with equity from their limited partners. So indeed, it might not hurt them directly, but the fact that high interest rates hurts the broader economy, and if interest rates go up, costs go up. So the costs of customers of these startups are going to go up, and that's why you're seeing these startups they experience a slowdown in growth. It's all interconnected. So, I wouldn't say a rise in interest rates is going to impact VCs directly, but will indirectly, because these startups experience a slowdown in growth because of the rise in interest rate environment. Times are getting tougher for most companies, and therefore these VCs are going to be less inclined to invest the same amount as there was before, because the growth's not there. Bear in mind, 12 months ago, VCs were not very kind of strict on price because the growth was there. They was just investing, wanted to be the lead investor in numerous startups because the growth was there. Now that growth isn't there. So it's because of the environment.
Okay. And another thing that I would like to ask is, for M&A, do you see it only happening with startups, or do you see, is there a possibility for companies like Palo Alto to make M&As even for bigger companies, maybe already listed companies? And as a consequence, do you see certain companies that are great M&A targets, or?
Yeah, good question. So, well, the likes of Palo Alto, they will likely continue with the type of bolt-on acquisitions that they have been very successful in doing over the last few years. In order to become the leader they are in cloud security, they made about 10 acquisitions in about 2.5 years and bolted them together. Oftentimes that is shareholder value destroying rather than shareholder value generating, because there's just so many examples of excess of the MMA is destructive. But Palo Alto Networks have like a secret recipe almost, where they acquire these small startups, bolt it onto a larger platform, do very well at integrating it. They empower their the startup founders to stay on and carry on their vision and give them a lot of the responsibility. And these factors have played a big part in Palo Alto's success. So I think Palo Alto, they will continue making these smaller acquisitions. I think it would be detrimental to their kind of technology stack if they made an acquisition of a much larger company, and it will just complicate any integration. Doing these small integrations every so often is just proven to be very, very value generating for shareholders. In terms of M&A targets at the moment, I think there's been some rumors that Sumo Logic could be a potential target. They kind of skirt on the peripheral of cybersecurity. They provide their main product is called a cloud SIM, which is basically a big kind of database of sorts that helps security operation analysts, kind of query against a set of data when they're trying to hunt for threats or stuff like that. So sumo logic at the moment, yeah, that might be something for investors to take a look at. Their share price dipped down and then it shot back up on these MMA rumors. But I need to take a look at that more closely.
Okay. So I'm done with the questions. If you have anything else to add, I'm here for it. If not, I really want to thank you for Jordan for your availability, for your great presentation, and we'll be looking forward to the next presentations of the companies you mentioned today. So,
yes, great. Thank you for having me, Giacomo. And yeah, hopefully we should maybe state to viewers that this might be the first of a series, right? Where this is the opening presentation, and in the future we can dive into specific companies and go into a bit more detail.
Okay, so this is it for today. I'm Giacomo. This is SaaS Hub. See you next time.